Do you remember this market crash? I was around when it was unfolding, and it wasn't nice. So how did the 2008 financial crisis happen? Let's examine it right now and try to understand why so many people consider it the greatest crisis since the Great Depression. First, a piece of ancient wisdom. Prevention is better than treatment. That's why please click those like and subscribe buttons to prevent my manager from telling me that no one likes my videos. Joking, nothing can prevent that. But I'll feel better if you click, and that's something. Alright, let's start. Seen from afar, global economic development almost everywhere happens in waves: contraction, expansion, deeper contraction, and then larger expansion. For example, the Great Depression of 1929 came after the expansion of the Roaring Twenties. That's how large living systems grow, a law of nature. That's why the financial crisis of 2008 came after some happy days as well. What were they? And why did they lead to such a massive crash? Let's take a look. The 90s and the early aughts were an interesting time. I was a teenager back then, and I still remember. To me, those times smelled of freedom. They were the era of Terminator, MTV, early gaming consoles, and fascinating commercials. In the US, it was an era of unstoppable construction and the housing boom. And when I say unstoppable, I mean it literally, because even the downturn of 2001 didn't stop it. Between 1998 and 2006, the average house prices rose 100%. The US had never seen such rapid price growth. In the early 2000s, nearly a half of all new private sector jobs came from employment demand of the housing sector. And finally, in 1998, the mortgage debt held by American households was in the range of 50% of national GDP. By 2006, it was nearly 100%. Unbelievable figures! How was all that possible? Well, nothing is possible without the banks, as you already know. Back then, banks were giving out loans like candy. And this sounds just like the Roaring Twenties right before the Great Depression, doesn't it? But wait, there is more. First, let's summarize. 3 factors were at play in the US right before the financial crisis of 2008. First, loose banking policies. Second, overheated housing prices. Third, absolutely mad property speculation. Together, they created a malignant economic bubble, which once it burst, led to the housing market crash and the ensuing economic collapse. And that bubble is called subprime mortgages. What is a mortgage? It's a loan with property as collateral. You come to the bank and ask for money. The bank gives it to you with the one condition: if you fail to repay, it's gonna take your house. So far, so good. Is the bank interested in giving you the loan? Yes, but only if it expects you to pay it back. If it does expect that, this situation is called a prime mortgage. In this scenario, you have a fairly high credit score and the bank trusts you. So you get a loan on standard terms and with a healthy interest rate. Good deal. The US had a nationwide affordable housing initiative back then. It means that potentially everyone, including those who could not afford and probably should not own a house, were encouraged to get a mortgage, a subprime mortgage. It's a high-risk loan given to a dubious borrower. The bank is not sure if it will get the money back, so it slaps a high interest rate and tricky terms on the loan. This subprime mortgage scheme seems fair for the bank because it gets higher interest in exchange for higher financial risk. It is also seemingly good for the borrower because now they can buy a house. Good deal? Do you remember the basics of trading mentality? Don't let greed cloud your judgment. Those aren't just words, because I don't see why cold-blooded bankers would overlook a risk of going completely bust unless their judgment was clouded by the promise of sky-high profits. So, picture this. Everyone is getting easy loans and buying property left and right. Banks aren't just giving away subprime mortgages en masse. They are packaging those high-risk loans into security portfolios so that investors, hedge funds, and other market sharks could mine profits like crazy. That wild nationwide money chase was not momentary, it was continuous. So what was feeding it? Some say it was economic projections. I would say it was vain hopes of endless housing price growth and foolish expectations of borrowers eventually repaying their subprime mortgages. Whatever the tunes of this crazy financial music were, it soon stopped.
I'm afraid that I don't hear a thing.
Here's what happened. Many people could not pay off their mortgages, so they started putting their shiny new houses up for sale. This selling wave engulfed the entire country, so eventually the house prices started falling. This means that even after selling their houses, many borrowers still could not pay off their loans. So the housing sector went into a downward spiral, and this in turn immediately affected employment. The entire asset-backed financial sector imploded. Bear Stearns was the first big bank to go down in the spring of 2008. Lehman Brothers went second and scored the largest bankruptcy filing in US history. $600 billion worth of assets were written off. Bank failures were spreading and the economy was falling apart. In 2008, the S&P index went from 1500 all the way down to 700, a nearly 50% splash. Unemployment reached 10%. Nearly 10 million Americans lost their homes. Finally, the crisis spilled over the border and went global. Those high-risk securities containing US mortgages that we talked about earlier were initially sold all over the world. So when the US market started collapsing, panic and losses quickly struck international banks and credit markets. In 2009, the world GDP went down 0.8% and the international trade shrunk 12%. The Eurozone unemployment almost reached 10%. There is more shocking numbers, but the short of it is, the same way I felt the spirit of freedom in the 90s. Everyone could now sense this wave of depression all over the world in 2008 and 2009. It had to be stopped. Bailout package was the word of the day in the US. The government basically agreed to buy the Wall Street's bad assets and spent $440 billion on the Troubled Asset Relief Program. In doing so, it essentially made huge investments in the collapsing banks to prevent their financial demise and further downslide of the economy. Then the Dodd-Frank Wall Street reform came in 2010. Big banks were limited in their activities with excessive risk and put under authorities' scrutiny. They were also obligated to maintain larger reserves. Eventually, and in fact quite soon, the economy started recovering, as you can see from that same S&P chart. So, what can we learn from the 2008 financial crisis? That no one learns anything from history? Just kidding. I think the most important lesson here is that your risk assessment must never be affected by greed or baseless hopes. Another important thing to remember is that you need to maintain reserves, which in your case means never spend more than 5% of your total balance on one trade. And finally, did you like how Jeremy Irons said that "I don't hear a thing" in the Margin Call movie about the crisis? Man, I loved it. I also liked Ryan Gosling in the Big Short movie. Go watch those movies if you haven't yet. See you.
Olymptrade. Care that counts.